Global markets showed signs of recovery with stocks rising and the US dollar pulling back from recent gains. Stock markets sold off earlier this week while Treasury yields and the US dollar surged to multi-month highs as investors were spooked by tensions in the Middle East. Locally, Oceania expects earnings to almost double after a strong first half performance. In a trading statement, the company, which owns brands like Lucky Star Tintfish, said it expected interim headline earnings per share to be between 89 and 99% higher. Meanwhile, U.S. futures for the S&P 500 and the Nasdaq are up as some chip stocks recouped losses after a sell-off. To give us more perspective on the markets, we are joined by Mohammed Wagley, who is a portfolio manager at Sasfin Wealth. Mohammed, thank you so much for your time. So let's get into your assessment of market sentiment. And I suppose at the same time, let's talk about how stocks are performing for the second quarter so far.
Thanks, Nastasia. Always a pleasure to be here. So with reference to the start of this quarter, I think, to sum it up quite simply, it's been a pretty rough start for markets since the beginning of April. The S&P is down about 4.5% in that period. Comparatively, the JSE's lost just over 2% since the start of the month. Now, to put those numbers into context, the American market had gained nearly 10% in the first quarter, and we've pretty much lost half of those gains since the start of April. Now, I think really what's been putting pressure on us is the weaker than expected inflation data that's been sort of bringing the market down, at least within relation to the US. I think the Federal Reserve there has been, quite consistent that their process would be data driven. So it does make sense here that there's been quite a bit of dampening of risk sentiment subsequent to those weaker than expected CPI data that came out a little bit earlier this week. And then we also had weaker data last week as well. So that's really what's been driving the weakness that we've been seeing.
I'm glad you brought up the Fed, and I want to ask, where are your rate cut calls so far? Have you changed them, like the market had to reprice them from 7 to 2 to almost none?
Yes, I think like with the rest of the broader market, I was very much sort of wrong in that respect. I think looking back to the end of last year, I think we had pretty much priced in that, we'd probably be seeing those first rate cuts in March, and then it became June, and then it became towards the end of the year. And that's really where we are currently. I suppose it depends where you look. The Europeans will probably start seeing rate cuts in June, but from an American perspective, it is actually looking unlikely that we'll start seeing those this year. In fact, I would say best case towards the end of this year, not looking likely currently.
Let's stay stateside. We've got US earnings season. On Friday, we had the banks, and they've wrapped it up for us on Monday in relation to the banks, that is. How high is the bar for US earnings this particular quarter?
Look, I think broadly speaking, they've been quite good. I think there's been about 48 companies that have thus far reported on Q1 earnings. On average, those earnings are up close to 10%. With specific reference to those banks that you mentioned, they were all up about 5% from the previous comparable period. So we had Citi, JP Morgan, I think Goldman Sachs a little bit earlier in the week, and they all did relatively well. So essentially on the back of those, I'd say, favorable reports, we're seeing earnings expectations improve. But, within the context of the companies that have reported, we've seen quite a few banks. I haven't seen too many of the bigger tech players come out, specifically the ones that really had stellar years last year. So perhaps it would be interesting to see the likes of Nvidia's numbers when they do come out a little bit later this month, or perhaps early into the next month.
What's important for investors? Is it US earnings or is it rates?
That's a good question. I'd say they're both definitely quite important, but what we've been seeing, over the past few weeks and, even further back the past few months is that the rate picture is definitely having a bigger impact on financial markets currently. I think this is the case of the longer term factor of the rates playing a bigger part than perhaps the shorter term Q1 earnings reports. This isn't to say that the earnings won't have an impact per se, but I think you can imagine that, let's say, one of the bigger tech players like Nvidia were to miss or beat expectations substantially, then we would see sort of that have knock-on effects that permeate throughout the broader market. For the time being, though, and actually in my mind for the foreseeable future, it does look like the story of financial markets will be very closely linked to that of inflation and the interest rate story. You can imagine I'm really tired of speaking about rates, but it seems like I'll be speaking about them for quite a bit longer.
Let me add another layer to that, and let's talk US yields. Are they trading where they are for the wrong or the right reasons?
It's interesting from my perspective. It seems fairly intuitive. I mentioned this earlier. We're in an environment where the risk sentiment is quite depressed. As a result of that, we're seeing a bit of a flight to safe haven. Investors are sort of sitting on the sidelines, awaiting a bit of certainty around the inflation picture. That's directly linked to what you had mentioned earlier, which is uncertainty around the oil, which then directly relates to that core inflation data. We're seeing gold prices at record highs. The dollar is really strong, and broadly speaking, those yields have been ticking up. I know they came down marginally yesterday, but again, broadly speaking, I'd expect these safe haven assets to sort of keep ticking up the longer the inflation uncertainty remains. Now, within the context of the US, that could be for quite some time longer, and I'd expect sort of South Africa to follow on in that regard. So it could be this way for quite some time, going forward, really.
I'm glad you brought up the dollar. How close are we till the strength that we're seeing in the dollar starts to break things?
It's an interesting question that I suppose, we've got to see how the broader market, survives. I guess the whole inflation and interest rate story. I wouldn't necessarily say that I expect the dollar to, substantially strengthen in the coming periods. One has to remember that we've got elections at the end of this month, at the end of May, forgive me, at the end of November. The Americans have election as well. So I'd imagine that there's, quite an interest to keep it relatively stable. I don't expect too much movement from where we are currently, but then again, it wouldn't shock me if we see sort of up to a 5% sort of downtick again.
Mohammed, thank you so much for your time. That is Mohammed Wagley, who's a portfolio manager at Sasfin Wealth.